Something is shifting in Bitcoin right now, and it's not subtle. The price action looks aggressive, the mood feels tense, and the traders who bet too early on a drop are getting punished. If you've been watching this market, you've probably noticed how quickly sentiment can flip from extreme fear to sudden relief. And when that happens, the move can feel less like a smooth trend and more like a Today we cover the key forces behind this moment. The idea of a realist cap in the options market, why Bitcoin can rebound sharply after extreme fear, what a central bank solidarity statement tells us about monetary power, the three lies critique about independence and price stability, how liquidity connects to asset inflation, what technical structure is forming on Bitcoin's chart, and why the 100,000 area is being framed as a new pressure point. Before we go further, keep one thing in mind. Markets don't move because a story sounds persuasive. They move because positioning, liquidity, incentives, and expectations collide upon in messy ways. So, when someone says, this is obviously what happens next, the better question is, what pressures are being released, and who is trapped on the wrong side? The first idea in your reference is simple. When a large block of option exposure expires, it can remove a kind of restraint on price. Some traders describe it like a cap or plug being removed. If a lot of hedging activity had been dampening volatility, its expiration can change the balance. The important point isn't the metaphor. The important point is that after key expirations, the market's microstructure can shift and price can move more freely. Now combine that with extreme fear. When fear is high, many participants are already positioned defensively. Some are short, some are underexposed, some are waiting for a deeper dip that never comes. That's when a strong upward move can feel violent, because it forces people to react. Shorts cover underinvested participants, chase, and the move feeds on itself. Your reference frames to post December 31st to move as a sharp rebound, roughly around a 10% rise into mid-January. Whether the exact figure is the takeaway or not, the broader point is, once the market realized the downside wasn't arriving on schedule, the path of least resistance turned upward. So the first big question becomes, what can we realistically expect next? That's where the second half of the video's logic comes in, because it ties Bitcoin's behavior to the broader monetary and policy environment. Quick recap. The setup is a market released from a constraint, combined with extreme fear unwinding into a rebounding that leads us straight into the bigger backdrop. Central banks, liquidity, and credibility. Now let's shift to the second question from your reference, because it's framed as the more uncomfortable one. It centers on a public statement of support for Jerome Powell, and it treats that statement as revealing not because of what it says on the surface, but because of what it implies. The line that gets highlighted is the claim that central bank independence is a cornerstone of price stability, financial stability, and broader economic stability. In the interest of citizens, that sounds calm, responsible, and almost ceremonial. But the critique you provided argues that the statement collapses under scrutiny, and it labels the whole thing the communique of three lies. This is educational content, not financial advice. The first lie, as presented, is about independence. The argument is, if central bank independence is supposedly essential, then why would a key central bank that is widely perceived as closely tied to political leadership not fit the narrative yet? Still plays a major role in global liquidity. The critique points to the idea that the largest liquidity engines are the US Federal Reserve System and China's central banking system, and it emphasizes that a system aligned with political authority undermines the simplistic claim that independence equals stability. Then the critique expands. Even in places where central banks are institutionally separate, they are still constrained by government financing needs, by debt dynamics, and by the requirement to prevent the public debt structure from In this framing, central banks behave less like detached technicians and more like guardians of a system that must be kept afloat. The rhetoric says independent, but the incentives say dependent. There is also a social layer. The idea that central banks function as protectors of asset holders. In the reference, central bankers are described as serving the wealthy by enabling liquidity conditions that inflate asset values. You don't have to accept the language to understand the mechanism being alleged. When liquidity expands and real yields are suppressed, assets especially scarce or leveraged ones often benefit first, while wages and purchasing power can lag. This critique also uses a relative value lens. Compare currencies to hard assets. When a currency steadily loses value against something like gold over long periods, it can be interpreted as monetary degradation. And when multiple assets, equities, precious metals, commodities, proper trend upward together, the argument is that it reflects the monetary environment more than everyone suddenly became more productive. Whether you agree with the tone or not, the takeaway is important. Public statements about independence and serving citizens can be read as messaging, not proof. Not proof. And messaging matters most when trust is fragile. Mini summary. This chapter reframes the central bank statement as PR language and questions whether independence is real in a debt-driven system, setting up the next claim. What price stability even means. If the first critique targets independence, the second targets the phrase price stability. Because here's the uncomfortable question. Price stability of what? In your reference, the argument is that central bankers can claim success if they focus on the price of consumer goods and services, or they can claim success if they focus on financial stability and market functioning. But those are not the same thing. And in practice, the prices that most visibly respond to liquidity conditions are often asset prices, real estate, commodities, and other financial instruments. The critique points out a world where multiple benchmarks are at or near highs. Major equity indices, metals, commodities, housing, and private credit expansion. Again, the details can vary across countries and time windows, but the core idea is that a sustained environment of easy liquidity tends to lift many boats at once. If everything is going up together, it's fair to ask whether we're seeing growth or denomination. In other words, are prices rising because value is being created, or because the measuring stick is being diluted? This line of thinking is often tied to what people call monetary debasement or monetary degradation. It's a loaded phrase, but the concept is straightforward. If the supply of money and credit expands faster than the production of goods and services, 10 of our time each unit of currency can buy less. Sometimes that shows up in consumer inflation. Sometimes it shows up more strongly in assets. Sometimes it's uneven, delayed, or politically managed through measurement choices. Your reference adds a distributional dimension. Wages as a share of national income can be pressured when asset prices surge faster than labor compensation. When capital assets inflate, owners of those assets can gain purchasing power, while wage earners may struggle to keep pace, especially when costs like housing rise. This isn't a moral claim by itself. It's a structural observation that policy choices can have winners and losers. From that perspective, the critique says central bankers cannot honestly claim they serve citizens if the outcomes systematically favor the already wealthy. It portrays central banks as institutions chosen by elites, insulated from direct democratic accountability, and focused on maintaining a system that requires continuous liquidity support. You can disagree with the framing, but it is worth understanding why people feel this way. When financial assets rally while ordinary costs feel heavy, trust erodes. So the second lie becomes, price stability is vague, selective, and sometimes defined in ways that ignore the parts of inflation that matter most to households, like housing and asset-driven cost pressures. In a summary, this chapter argues that price stability can be a selective label when asset inflation is ignored. That leads to the third critique. If central banks truly serve citizens, what would fair treatment look like in the next phase of money like digital currency? Now we get to the third lie critique, and it asks the most concrete, as it asks a transactional question. If central banks genuinely serve the public, why do the benefits of the system feel so one-sided? The reference ties this to the idea of a central bank digital currency. A digital euro concept and frames it as a tool of control. Whether you view that as an inevitable modernization or a serious civil liberty risk depends on your assumptions. But the critique is clear. A centrally issued digital currency could make it easier to monitor, restrict, or condition how money is used. And once money becomes programmable, policy can become personal. The reference gives an example: penalties or restrictions tied to carbon footprint. That's a speculative scenario in the sense that implementation details would be political decisions. But it illustrates the fear. that digital currency could be used not only to facilitate payments, but to enforce behavioral rules. Then comes the key fairness question. If citizens deposit value into a central bank digital system and receive a digital token in exchange, who earns the return on that value? In the critique, the digital token is treated as inferior to cash because it could carry conditions or limitations. Meanwhile, the issuer directly or indirectly could benefit from controlling settlement, liquidity channels, and the broader financial plumbing. So the proposed test is simple. If central banks claim they serve citizens, would they share yield? Would they pay interest on the digital currency? The logic is that if the system captures value from users, the users should receive a portion of the benefit otherwise. It looks like extraction disguised as service. This touches a deeper theme. Modern money is not just an object, it's a governance system. Rules about interest, access, identity, and transaction permissions shape who gets flexibility and who gets friction. That's why discussions about digital currency often become emotionally charged there. Not only about technology, they're about power. At this point in the narrative, the reference pivots back to Bitcoin, almost as an implied contrast. Because whatever you think about Bitcoin as an asset, it represents a system that isn't issued by a central bank, isn't programmable by a single authority, and doesn't require permission to hold or transfer. That doesn't make it risk-free. It does make it different. So the third lie becomes, if institutions claim they act in citizens' interests, we should judge them by design. Choices like whether digital money increases freedom or increases control, and whether benefits flow outward or upward. Mini summary. This chapter frames digital currency as a potential lever of control and asks whether the public would share in the upside. Then it sets up the return to Bitcoin as a market response to monetary policy and credibility. Let's return to Bitcoin, because the reference treats the chart as the place where all these macro and policy narratives collide with reality. The starting point is the cap-removed idea. After a major options expiration, price is less constrained by the hedging flows associated with that expiry. But the reference adds an important caution. Even if constraints are removed, markets rarely deliver an exact outcome on a predictable schedule. In other words, the plug is out doesn't mean price instantly launches. It means conditions allow movement. But movement still needs fuel. And in the reference, the fuel is positioning and structure. The market is described as moving sideways, compressing, and forming a triangle-like pattern that looks like it could be building a base. That type of structure matters because it often reflects balance. Buyers and sellers are both active, but neither side is winning decisively. Volatility compresses. People get bored. Then a break can arrive that feels dramatic simply because everyone got used to quiet. The key technical idea highlighted is a long-term line, what the reference calls the line that changed everything. This is essentially a trend line constructed by connecting major historical points, prior cycle peaks, key pullback lows, and later highs. Whether you draw it exactly the same way is less important than the concept. A multi-year trend line becomes a psychological boundary. When price holds above it, many traders interpret it as confirmation that the broader uptrend is intact. When price breaks below and fails to recover, the narrative often flips toward structural weakness. The reference's stance is clear. As long as Bitcoin stays above that line, the more probable scenario is that the uptrend remains alive. That is not a guarantee. It's a conditional claim. If this holds, then the bullish structure remains more plausible. This is where macro re-enters the story. The reference argues that fiat currencies are being pushed down relative to scarce assets, and that Bitcoin should, over time, move in a similar direction to gold, stocks, and other inflation-sensitive or scarcity-linked assets. It's the classic idea. If liquidity expands and purchasing power erodes, scarce or desirable assets become a hedge knot perfectly. But often, here's the key nuance. Bitcoin can behave like a hedge in some regimes, and like a risk asset in others. It can correlate with tech stocks during liquidity-driven rallies, and it can decouple during moments of crisis or narrative shifts. That is why technical structure is emphasized. The chart is where all these forces get netted out. Mini summary. This chapter argues that microstructure plus a compressing chart can set up a break, and that a long-term trend becomes the boundary for the bullish case next. We'll focus on the 100,000 zone and why it is framed as the next cap. Now we move from structure to targets, because the reference introduces a specific level as a near-term magnet. 100,000. When people talk about round numbers in Bitcoin, it can sound like superstition, but there's a practical reason they matter. Round numbers attract attention, and attention attracts orders. Large levels often become places where traders cluster stop losses, take profits, and option strikes. So even if a number is psychologically arbitrary, the behavior around it can be very real. The reference frames 100,000 as a new cap, not necessarily because the market can't go higher, but because positioning in options markets can create resistance. Specifically, it claims that large players, often referred to as whales, are selling call options around that level. If that's happening, it implies that some sophisticated participants are getting paid premium to bet that price will struggle to break and sustain above that zone in the near term. Here's what matters about that logic. Option selling can influence dealer hedging behavior. Depending on the structure, it can create a pinning effect or a zone of friction, where moves above the strike get sold into and moves below get supported, keeping price trapped. That's not always the outcome, but it's a known dynamic in markets where options flows are heavy. So when the reference says the cap is at 100,000, it is really saying there may be a high concentration of positioning there that could slow the move. That turns 100,000 into a battlefield rather than a finish line. Then the reference links that battlefield to a date, January 31st, when another large expiration is expected. The idea is that if options positioning is restraining price, then the expiration could remove that restraint potentially, allowing the market to trend higher if other conditions support it. Again, treat this carefully. Expiration is not a magic switch. Sometimes price rallies into it and then stalls. Sometimes it dumps before and rebounds after. The more reliable insight is the conditional one. Large expirations can change the landscape, so traders watch them because they can alter volatility and flow. Now, combine this with the broader macro framing in the reference. Central banks and governments have incentives to manage debt, maintain confidence, and avoid systemic stress. In such a world, hard assets and scarce assets can benefit, especially if policy remains biased toward liquidity support. The reference adds a political angle, suggesting that certain leaders might prefer higher gold than Bitcoin prices for accounting or strategic reasons. That's a big claim and should be treated as interpretation rather than settled fact. But the more general point is valid. Governments sometimes benefit from inflation or asset appreciation in ways that aren't obvious to citizens. Mini summary. This chapter explains why 100,000 can act as friction due to option positioning, and why a major expiration date can reshape flows next week. HODL. Connect that to the broader liquidity everywhere environment, and why so many assets can rise together. If you step back from Bitcoin for a moment, the reference is painting a bigger picture. A world where almost everything is being inflated, and where people are told it's stable. That sounds paradoxical, but it's a familiar pattern in modern finance. When money and credit are abundant, and when policymakers are sensitive to recession, risk, or debt stress, financial conditions can remain supportive for long stretches. That doesn't mean the economy is always strong. It means the financial system is being managed in a way that reduces immediate pain-off and at the cost of longer-term distortion. In the reference, this is expressed through a list of assets that appear to be making highs: equities, metals, commodities, housing, and credit. The implication is that when everything rises together, the common denominator might not be productivity, it might be liquidity. One way to understand this is to imagine the economy as a set of containers. Liquidity flows into the easiest containers. First, liquid markets, with clear price discovery like stocks and bonds. Then it leaks into less liquid areas: real estate, private credit, alternative assets. The people closest to the liquidity source, large institutions, banks, major asset holders, can often deploy capital earlier and more efficiently. That's where the distribution critique comes from. Now, bring Bitcoin back into that map. Bitcoin is a globally traded asset with a fixed supply schedule. That's why it gets placed in the scarcity category alongside things like gold. In a world where the measuring stick keeps changing, scarcity assets become a way of anchoring value at least in theory. But the reference is also pointing to something else: the emotional cycle. When liquidity is abundant, speculation increases. When conditions tighten, weak hands get shaken out. Fear spikes. Then when pressure releases through policy shifts, expirations, or simple exhaustion, price rebounds sharply, trapping the impatient bears. This is why the reference calls attention to incinerated impatient bears. It's not just mocking. It's a lesson about timing. You can be right about a macro concern and still get wrecked if you early or over. Markets punish certainty more than they punish uncertainty. So what does that imply for the new? It implies that if Bitcoin is in a compressing structure, above a key long-term boundary, and supported by a broader scarcity narrative, then upside continuation is plausibly, especially if a major options restraint is removed. But plausible is not guaranteed. Mini summary: this chapter ties the Bitcoin move to a broader liquidity-driven environment and highlights how timing and leverage determine who gets punished next. We'll zoom back into the chart logic and what holding the line really means for scenario planning. Let's talk about holding the line, because the reference treats that trend line as the hinge between two very different stories. Technically, a trend line is just a way of describing momentum over time, but psychologically, it's a shared belief. If enough participants watch a level, their actions can make it matter. It becomes a coordination point. Buyers feel safer above it, sellers feel more confident below it, and neutral participants wait for confirmation. In the reference, a trend line is drawn using major historical anchors points that many traders would naturally pay attention to across cycles. That's important because the longer the time frame, the more participants can agree on the significance. A daily chart line might matter to short-term traders. A multi-year line can matter to institutions, long-term holders, and macro-oriented participants. The claim is straightforward. As long as Bitcoin remains above that boundary, the uptrend case remains intact. That suggests a scenario framework rather than a prediction. Scenario 1. The line holds. In this case, pullbacks are treated as corrections within an uptrend. Traders look for higher lows. Momentum can rebuild. The market has room to attack resistance zones like the 100,000 areas, especially if liquidity and positioning align. Scenario 2. The line breaks and price fails to reclaim it. In that case, the market's character can change. People who were buying dips begin to hesitate. Long-term confidence weakens. A sideways base can turn into a distribution range, and what looked like a healthy pause can become the start of a deeper rebound. What's valuable about this approach is that it forces discipline. Instead of arguing endlessly about narratives, you define what would falsify your thesis. If you're bullish, you identify the level that would make you reconsider. If you're bearish, you identify the level that would prove you wrong. That's also why the reference emphasizes that a 10% move in a couple of weeks isn't automatic or guaranteed. Markets breathe. Even in bull trends, there are pauses. Even in downtrends, there are brutal rallies. The structure matters because it tells you whether the market is absorbing supply or failing to. Now, the reference connects this to central banks again. If fiat currencies lose value over time relative to hard assets, 10T. Long-term gravitational pull favors scarce assets. This doesn't mean a straight line up. It means that, in a world of persistent monetary expansion, the long-term bias can remain supportive. Mini summary. This chapter turns the trend line into a scenario tool hold above it, and the bullish structure stays credible. Lose it and the story changes next. We'll examine why option caps matter psychologically and mechanically, and why expirations can trigger outsized reactions. The cap metaphor in the reference is doing two jobs at once: explaining mechanics and shaping expectations. Mechanically, the idea is that large option positions can influence how price behaves near certain levels. Psychologically, it gives people a story. Once the cap is removed, price can run. Stories can be dangerous in markets, but they can also highlight real forces. So let's treat it carefully. Options concentrate risk at specific strikes. When there's heavy activity, market makers and dealers hedge their exposure by buying or selling the underlying asset. Those hedges can dampen or amplify moves, depending on whether positioning is net long, net short, or dynamically changing as price approaches key strikes. If a large group is selling calls at a level like 100,000, the simple interpretation is they expect resistance or they're monetizing demand for upside exposure. But the more important part is how the broader market responds. If buyers keep pushing price upward and the strike gets threatened, hedging flows can flip and create a squeeze-like move. If buyers lack conviction, that same strike becomes a ceiling. Then expiration arrives. Some positions disappear, some roll forward. Some participants re-hedge. The landscape changes. Sometimes volatility drops because the event risk is gone. Sometimes volatility spikes because the market was pinned and suddenly released. That's why the reference points to January 31st as a potential inflection point. Not because the date itself has magic, but because many participants may be repositioning around it. And when many people do the same thing at once, markets can move sharply. Now add the emotional piece from the reference. Impatient bears getting burned. Options dynamics can magnify that. If shorts are leaning in and price pushes up into a key strike, the mechanical flows and the psychological panic can line up. That's when moves feel violent. But remember, the market can also do the opposite. It can run into a big level, fail, and retrace. The point isn't to worship the date. The point is to understand that dates tied to major expirations often bring heightened sensitivity. In the reference, the rebound after December 31st is used as evidence that removing constraints can trigger sharp moves, especially when fear is extreme. The implied lesson is, if you see extreme positioning in a structural compression, don't assume the market will politely move in the direction that feels obvious. Mini-summary. This chapter explains how option strikes can act like ceilings or magnets, and why expirations can reshuffle flows and trigger sharp moves. Next, we connect this to the broader credibility problem. Why institutional messaging can clash with lived experience, pushing people toward alternative stores of value. At the heart of your reference is a credibility gap. Institutions claim stability, service, and independence. Many citizens experience rising costs, asset inflation, and the feeling that the system rewards those already positioned. When that gap widens, people look for alternatives. Sometimes those alternatives are political. Sometimes they're cultural, and sometimes they're financial, like gold, Bitcoin, or other scarce assets. The reference frames central bank messaging as performative, a statement of solidarity that sounds caring and responsible, but fails the test of reality. If central banks are truly independent, why do they repeatedly align with government financing needs? If they truly deliver price stability, why do asset prices and housing feel permanently elevated? If they truly serve citizens, why do proposed monetary upgrades feel like tools of control rather than tools of empowerment? Again, you don't have to accept every claim to see why the argument resonates. Money is the operating system of society. When the operating system feels rigged, trust decays. Bitcoin enters the story as a kind of protest asset, an exit valve. It doesn't require trust in a central issuer. It's globally transferable. Its supply schedule is known in advance. That doesn't make it immune to volatility, scams, or speculative excess. It just means its rules aren't changed by a committee meeting. The reference also uses a relative framing. Fiat currencies falling against gold over time, tending towards zero in that ratio. That kind of chart can be persuasive because it simplifies the message. The currency loses purchasing power relative to a hard asset. While the exact path is complex, the broad historical trend of fiat purchasing power declining over long periods is widely understood. So when people hear central banks talk about stability, they may interpret it as stability of the system, not necessarily stability of their own purchasing power. And when people hear about digital currency, more oversight, not more freedom. From that perspective, Bitcoin's rebound after a fear-heavy period isn't just a trading event. It's a signal of demand for an alternative asset in a world where liquidity and debt are permanent features. In a summary, this chapter frames Bitcoin SPO as partly mechanical and partly philosophical and exit from a system that feels less trustworthy. Next, I'll tie everything together into a practical reading of the near term. Triangle compression, the 100,000 cap, and what market behavior around January 31st could indicate. Let's pull the threads together into a near-term map, using the reference's own logic but keeping it disciplined. First, the structure. Bitcoin is described as moving sideways, compressing, and potentially building a base. That usually means volatility is being stored. The longer a market compresses, the more meaningful a break can be, because it represents a resolution of indecision. Second, the boundary. The long-term the reference treats it as the line that defines the bullish structure. Above it, the uptrend remains plausible. Below it, the story changes. That's a clean framework because it reduces overconfidence. It's not Bitcoin must go up. It's Bitcoin's structure stays bullish if this holds. Third, the target. 100,000. The reference frames it as a near-term destination and a possible ceiling because of option positioning. That turns 100,000 into a zone to watch for behavior, not just price. Does the market stall repeatedly there? Does it get rejected violently? Or does it grind through and hold above? Fourth, the event. January 31st. Options expiration. The reference treats this as another moment when constraints could be removed. If the market is pressing upward into that date, it could mean participants are positioning for a breakout. If the market fails into that date, it could mean the cap is holding and traders are taking risk off. But the most useful way to use this is not prediction, it's observation. Markets revealed their intent through reactions. A strong market shrugs off bad news and holds levels. A weak market fails on good news and loses support. So instead of arguing about what should happen, watch what happens around the key zones. The reference also adds a macro tailwind argument. Broader liquidity conditions and the long-term erosion of fiat purchasing power support scarce assets. That can help explain why sharp rebounds occur after fear spikes. But it doesn't remove short-term risk. Bitcoin can still correct hard. It can still fake out. It can still chop for longer than people expect. So the near-term playbook is watch the trend line boundary for structural integrity. Watch 100,000 for friction and positioning. And watch how the market behaves into and after a major expiration date. Mini summary. This chapter converts the reference into a practical map structure, boundary, target, event so you can interpret what the market is showing you next, rather than trusting a single narrative next we. LL address. The broader implication. Why the three lies? Critique matters for long-term holders, and what it suggests about the role of Bitcoin in a world of debt and liquidity. The three lies critique in your reference isn't just a rant about central banks. It is an attempt to explain why people feel pushed toward assets like Bitcoin in the first place. If independence is questionable, then policy may be more political than advertised. If price stability is selective, then the lived experience of inflation, especially housing and asset-driven costs, can feel ignored. And if serving citizens is mostly rhetorical, then new monetary technologies like digital currency can look like control systems rather than public goods. In that worldview, Bitcoin becomes a long-term insurance policy against institutional overreach and monetary dilution. Not a perfect hedge, not a guaranteed win, but a different kind of asset with different rules. The reference also hints at a broader debt theme. Governments run large deficits, issue large amounts of debt, and rely on financial conditions that prevent that structure from becoming unstable. In such a world, policymakers often prefer outcomes that reduce stress like lower real interest burdens, higher nominal growth, or asset appreciation that supports balance sheets. That's one reason hard assets can thrive over long cycles. They benefit from the environment created by debt management. But the reference's key message for long-term holders is not everything as a conspiracy. Its incentives matter. Institutions respond to incentives. Markets respond to incentives. And if the system's incentive is to keep liquidity available and debt serviceable, the long-term environment can remain favorable to scarce assets. At the same time, the reference implicitly warns against impatience and leverage. Those impatient bears weren't necessarily wrong to be skeptical. They were wrong to be early, or wrong to be positioned in a way that couldn't survive a squeeze. In Bitcoin, surviving is part of winning. Timing matters. Position sizing matters. And emotional discipline matters. So the value of this whole framework is not that it predicts a price on a date. It's that it gives you a lens. Watch liquidity. Watch trust. Watch structure. And don't underestimate how quickly positioning can unwind. Mini summary. This chapter explains why distrust in monetary institutions can drive long-term demand for Bitcoin, while reminding you that market survival requires discipline. Next we LL, close by, tying the near-term cap narrative to the long-term scarcity narrative, and why the best investors focus on process over drama. So where does that leave us? In the near term, the reference is clear. Bitcoin has rebounded sharply after a major expiration. Fear has been unwinding, and the market appears to be compressing in a structure that could resolve higher if key support holds. The 100,000 zone is framed as the next pressure point, potentially reinforced by options positioning, and another major expiration date. January 31st is treated as a moment where flows could shift again. In the bigger picture, the reference argues that central bank messaging is losing credibility because outcomes don't match the promises. Independence is questioned. Price stability is questioned. Serving citizens is questioned, especially when digital currency proposals feel like they could increase control without sharing benefits. Whether you agree with every conclusion or not, this credibility debate is part of why scarce assets remain culturally and financially relevant. Bitcoin sits at the crossroads of these ideas. It asks both a market instrument shaped by derivatives and positioning, and a monetary alternative shaped by trust and governance. That's why it can trade like a better risk asset in 1 month, and like a long-term scarcity narrative in another. Both truths can exist at the same time. The healthiest approach is to separate signal from theater. Use levels as a framework, not as prophecy. Treat big dates like expirations as information, not destiny. And remember that market participants aren't rewarded for being dramatic, they're rewarded for being resilient. So, if you're watching Bitcoin right now, don't just ask, will it hit 100,000? Ask, how is it behaving around the levels that matter? Is it holding the long-term boundary? Is it absorbing selling pressure near resistance? Is liquidity supportive? Are people overconfident on one side of the trade? Because in the end, the market doesn't care about our narratives. It cares about positioning, incentives, and flow. And when those align, the move can be fast, surprising, and unforgiving.